Hello everybody, this is Ghabour. Please subscribe to our YouTube channel for up-to-date market updates as well as educational videos that we try to push out as often as we can to help everyday investors try to make sense of this market and, more importantly, do things that they think can help their family grow their wealth and hit their financial goals. So I wanted to put this video out because as I'm shooting this, we have now hit the new lows of the year that just a few weeks ago people thought was not possibly going to happen because we were going through another bear market rally. And it's interesting, the question that we're getting all the time is, or at least I should say this week, is how we have looked at the market in a different way than what most have, okay? During this bear market bounce, we were very, very consistent with the fact that we thought the market would hit new lows before they hit new highs. And I know every time we've had this bear market bounce, you'll see people change their mind. They'll go from bearish to bullish, and we did not. And I want to talk a little bit about why we did not to hopefully help educate you the next time you're in this position to not have to flip-flop. I agree with the comment that people make in regards that you can't time markets. It is impossible. I don't know when the exact bottom's going to be. I don't know when the exact top is going to be. So you can't time that, but you can, in my opinion, if you understand how macro works or you have good research at your disposal that helps you understand macro, if you can get the economic cycle right, a lot of times it can help position you in a way that you don't get sucked into these bear market bounces, because that's essentially what happens. And I hate to see it when it happens because the retail investors are usually the ones that get hurt the most. You get these bear market rallies. They hear someone on TV talk about the bottom is in, and then they go in with both feet and buy. So the reason why we stayed very consistent with our message to our clients and why we continue to hold a very large cash position for them is because we understand that the economic cycle hasn't come close to bottoming yet. When you take a look at how this economy is slowing down, this is not something that turns around in a matter of weeks or months. It could take a year until you see things pivot and start going in the right direction. Now, make no mistake, there's been a lot of carnage that has happened in this market, and there's going to be some great buying opportunities, in my opinion, in the next 6 months. And if you're a trader, you may have some opportunities today. Who knows? Because the one thing we do know is we are going to continue to get bear market bounces throughout this. But here are the things that we're looking at right now. Number one is the balance sheet of the Federal Reserve, okay? I made a comment a few weeks ago on Twitter as well as on Fox Business that the balance sheet had actually reduced in a sizable way at the beginning part of the month. But one thing that we found interesting is heading into this rate hike this week that the balance sheet actually increased. So they're supposed to be reducing the balance sheet by $90 billion a month. And they were on pace to do that in the beginning part of the month. But heading into today's rate hike, they actually didn't do that. They actually bought bonds. So that kind of gave us a signal that, okay, the Fed realizes they're not stupid, right? They know that if they reduce the balance sheet that aggressively during a rate hike, that they could really disrupt the capital markets. And that's something we're watching very closely in regards to how the debt markets are reacting. And the bond market has had this thing right the whole time. And this is why I continue to try to educate our clients on the fact that we put more weight on what the bond market is saying versus the stock market. The yield curve inversion this week was the largest inversion that we have ever seen. That's a long time. And it's been inverted for a substantial period of time. And so the fact that people want to try to convince us that there is no recession or we're going to have a soft landing, I think is absolutely ludicrous. We are heading into a recession, in our opinion, and if the Fed continues down the path that they're telling us they're going to go on, it's going to be much deeper than what many people are pricing in. So when you are looking at an economic cycle that started in January, I would say, where you really started to see deceleration, it started off slowly, and now it's starting to accelerate. And I think when you start to hear fourth quarter earnings, revisions to earnings, and the outlook for next year from these companies, I think it's going to be crystal clear to the Fed and to everyone out there that's been trying to call a bottom that this economy is slowing down much faster than anyone had priced into this market. This is why we did not believe that we were at a bottom this summer, because the rate of acceleration on the economy and the consumer is going in the wrong direction. This market will not bottom, in our opinion, until that change starts to become small changes. Right now, month by month by month, the way we're looking at it through our lens, this economy is slowing down at a faster pace each month. So that rate of change matters. When the rate of change starts to tighten up, as I like to call it with my team, that means that we're probably close or getting closer to the bottom of the economic cycle in regards to getting worse. Now, one thing I want to stress here is this. We've continued to say now that we're going to have buying opportunities in the fourth quarter, which we think that we will. And what I'll do today is I'll kind of telegraph some of the things we've done for our clients. But the real bottom, in our opinion, to the higher risk assets like growth and small caps are probably not going to happen until the first half of next year. That doesn't mean the economy is going to turn. This market will bottom before the economy turns. But we believe that the first half of next year is when we'll see a market bottom, even though the economy is actually going to get worse until 2023. So when you look at the economic data and you compare 2023 to 2022, we believe the economy will be much worse in 2023 from an overall year-over-year perspective than it is in 2022. But we think the market will have a much better year next year than it did this year, because the market is a forward-looking indicator. So the bonds told us we weren't going to have a bottom. The dollar told us we were not going to have a bottom. The rate of change on this economy and the way the consumer is behaving told us we were not going to be at a bottom. And the Fed's action told us we were not going to be at a bottom. So those four things carried a tremendous amount of weight in our decision to stay extremely disciplined with our portfolios and hold tight to the cash that we have. So now let me take a step back again, because I want to try to educate as many as I can, because obviously most of these people watching this video are not our clients. So it's no secret, we got in our tactical strategies that we manage based on more of a shorter term outlook. We got out of the small caps, we got out of the NASDAQ. We basically sold everything that we owned last year. And I've never done that before. But as I said, this was the mother of all bubbles coming into 2022, and it was the worst setup that I've seen in my career. Now, I've only done this for 20-some years. There are 40-plus year veterans that I'd love to hear if it was the worst setup that they've seen. But because of that, we got out of everything that we had. And so we're looking right now at our portfolio construction and our tactical strategies, and we have over 60% cash. We are sitting on utilities, consumer staples. In regards to the equity side, are the only two equity holdings that we have, along with energy. I apologize, I almost forgot about that. We have a small percentage in energy, and then we have treasury bills. And we have a little bit of metals in the portfolio. But with over 60+% cash in the portfolio, obviously we don't have a huge weighting in any of those things. So now the next trick that we're going to have to do here is, when do we start buying back in? So here's our game plan. We did actually buy a little bit of longer term treasuries this week for our clients, because again, we think this economy is going to slow down materially. We think the long-term rates are going to go down. So long-term treasuries, in our opinion, are going to show quite a bit of upside next year. That's our opinion. That's how we're positioning and playing this. So we're going to use this cash and slowly buy treasuries. Then we're going to slowly buy some of the defensive names. We'll probably add healthcare. We'll add more to consumer staples. Probably add more to utilities, but we're probably going to wait till we get in the mid-30s on the VIX, which could happen any day now, until we do that. And so the equities that we'll buy here in the fourth quarter are going to be more defensive in nature. And then, of course, there's no secret how we feel about the bonds. It won't be until the first quarter of next year, more than likely, unless we materially go down this year, until we'll start buying small caps, NASDAQ, maybe some chip companies. But we think we will have an amazing, amazing buying opportunity next year in the highest risk asset classes. But they have to come down a lot more than where they are now before we'll start buying those. So being in a position to have cash, it was like funny, some of the, I'll call it constructive criticism we got is, well, if you're sitting on that much cash, it's not working for you and it's not beating inflation. True, but it sure as hell beats losing 30% of your money because you're just going to stay in growth. So we made a bold decision that there was very few places to hide this year. And ultimately, as we were de-risking portfolios, we got ourselves to this position where we have a very high cash position. And we could have been dead wrong, we know that, and we could be dead wrong now. But the only people that can benefit from a major loss in equity markets are those that have cash. It's easy for someone like myself to come on TV and say, buy the dip, buy the dip. But understand, as an investor, you have to have something to be able to buy it with. And so this is why we've stayed away from growth. We haven't chased any of these bear market bounces. And I've just telegraphed with you what we plan to do with this cash. Now, we're not going to deploy all this cash. Those defensive names that we're going to buy and the treasuries we're going to buy, we're not going to use all that cash to buy that. We're going to keep probably a pretty sizable cash position going into next year. If I had to put a number on it now, maybe 30, 35%. We'll have to wait and see. We're going to do what the market is telling us to do. And right now, I'm just trying to help you so you can kind of see how we're looking at the markets through our lens and what our game plan is. But again, I want to stress this. I've never had this much cash for clients. Our firm has never had this much cash for clients. I'm thankful that we did, of course. But based on what I think things are going to do here over the foreseeable future, we will probably never see an environment like this again in my career where we have to be that drastic on cash. But it's because, again, we're probably not going to see a bubble the size that we just saw in 2021. And so my hope is we'll have a more normalized market moving forward next year, but there's going to be a lot of carnage. When will I know, or at least feel like I know, that the bottom is almost really in? Unfortunate reality is going to be probably when some of the darlings of last year go bankrupt or their stocks go to zero or close to zero and someone has to come in and bail them out. It's an unfortunate reality of what happens when every bubble bursts, is there is going to be a lot of carnage. Okay? So this video was longer than I normally shoot, but I wanted to take some time to not only talk about why we didn't think the bottom was in, but just as importantly, share with you what we're planning to do for our clients, because who knows, maybe it'll help you manage your wealth in a way that is in line with your goals and objectives and help you and your family take advantage of this volatility that we're being faced with, because this is a tough time for many investors, and I'm very sensitive to that. So with that being said, I hope you found this video to be educational and bring value to you and your family, and hope that you can make this next week a winning week. So thank you and have a great day.